some point between now and let's call it this time next year, markets are going to have to capitulate to the upside on these ridiculously low growth expectations, which will drag earnings expectations higher and market multiples higher, credit spreads lower. And this is how you wind up with an explosive bull market on risk assets.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Of all the people I've interviewed since launching this Thoughtful Money channel, today's guest's portfolio management track record has been spookily accurate. The last time I interviewed him, which was back in mid-March, he had drastically reduced his long positions and declared himself, quote, ragingly bearish. And in the weeks that followed, the S&P plunged nearly 700 points to the post-Liberation Day lows. So, how is he feeling about the markets now? To find out, we'll ask the man himself. We're very fortunate to welcome back to the program Darius Dale, CEO of 42 Macro, a top Wall Street leading macro forecasting and market timing service. Darius, thanks so much for joining us today.
I mean, you're too kind with these intros, man. I appreciate you, brother. Thank you so much. It's great to be here.
Thank you. Well, look, it's nothing but the truth. I mean, I got to say it. I didn't burnish anything. It was just all true. Thank you for coming on the show in general here, Darius. Thank you specifically for coming on right now, because basically as we were hopping on Zoom here, the Fed guidance was just released. So I know you took maybe a 2 nanosecond glimpse at it. Maybe we'll talk a little bit about it, but I know you got to do a lot of work to make sense of that for your clients. So we'll get through this interview as fast as we can. And also anything that you say here related to that news, I just want to put a big asterisk on it that you haven't had a chance to really digest it. We haven't watched the Jerome Powell press conference yet. So there's a lot we don't know.
Well, again, you're too kind. In my opinion, most of the work is done beforehand. It's about preparation in life, whether you're an investor or any other field of discipline. And secondarily, our key takeaways from this Fed meeting as it relates to the dot plot and the updated summary of economic projections pertain more to 2026 pricing than they do to 2025. So irrespective of what Jay says in this press conference, it's highly unlikely to change our views.
Okay. Well, we'll get to those views now. So as I said in the intro there, last time we spoke, which was for the Thoughtful Money Spring Online Conference, which was back in mid-March, as I said, you were categorizing yourself as ragingly bearish. And that was after having been pretty darn bullish correctly for the previous 2 years. Since then, the markets, plummeted, as I mentioned, and then they've come roaring back. So are you bullish or bearish now or something else?
Yeah, no, I appreciate that. And I will give you a slight correction. Not pretty darn bullish, as I really said on your program. I was as bullish as I'd ever been.
Yep.
Going back to the fall of 23. So no, we were on the right side of that bull market beginning in January of 2023. Generally kept our clients on the right side of that via our KISS system. KISS finally started to take down risk in February of 2025. It got us to 100% cash, I want to say on March 3rd or March 5th of 2025, and was at 100% cash up until April 14th. April 14th, KISS started buying Bitcoin in April, and on April 30th, it started buying S&P 500. And so obviously, I think, this is just another example of KISS risk managing, big swings in financial markets much better than what I think we can do, including myself, with our puny human brains in the middle of a fourth turning poly crisis. So if you hear one thing, if you take away one thing from this interview, folks, I highly recommend you arming yourself with, institutional grade risk management overlays that can, help, essentially chop off the left tail of the return distribution so that you can sleep comfortably at night while also remaining, invested in these asset markets. Because I'll tell you one thing, our clients have, been making money hand over fist, since mid to late April, and everyone else is, arguing and pulling their whatever hair they have left out, talking about tariffs and Orange Man and his flip flopping and everything else that's got them upset. But the reality is, there's been plenty of money to be made since we effectively manage risk, and our clients are happily making that money.
All right. Well, so a couple clarifications. One, you've referenced KISS a couple of times. Just for folks that haven't seen our previous interviews, that is the name of the really reductive model that is the output of the massive amounts of data that you guys crunch and synthesize for your clients there at 42 Macro. It is some would call it a 3-input model. I guess I'd call it a four input model with cash or T-bills being the fourth, right? So you trade in a stock index, you trade in Bitcoin, and you trade in gold. And then every so often the model may tell you to get, more into cash. So you keep it very simple. And the KISS acronym stands for Keep It Simple and Systematic, if I remember correctly.
100%.
Okay,
Absolutely. I mean, we might as well just put a chart on the screen. We can go back to KISS towards the end of the program, but I think it's always easy just to
sure. Why don't we? Yeah, exactly.
give
Let's
us
give
my
people
key
what they
points.
really want. Let's put the punchline right up front here.
Exactly. And so you're spot on in terms of how you describe KISS. KISS is a completely systematic risk management overlay to help investors guide their, gross exposure in their portfolio to what we think are the three most important asset classes you need to be exposed to safely navigate a forward turning poly crisis: stocks, gold, and Bitcoin. And so how KISS manages exposure up or down with regards to these asset classes, it uses our market regime nowcasting process to incorporate volatility targeting into the strategy, which is one of the hallmarks of institutional risk management. And then it uses our volatility adjusted momentum signal for these particular assets to incorporate dynamic position sizing into the strategy, which is another hallmark of institutional risk management. And again, this is what the top hedge funds in the world are doing to keep themselves and their clients on the right side of market risk. And we're proud to present that to everyday investors vis-a-vis KISS. And so in terms of how KISS works, at any given time, KISS could either be 100% invested, as it is currently, with 100% of 100% of its maximum exposure of 60% in stocks. It's got 100% of its maximum exposure of 30% in gold, and it currently has 100% of its maximum exposure of 10% in Bitcoin, which ultimately means it has 0% cash, or what we call liquidity. We use the floating rate treasuries to manage our liquidity, but the reality is there are a variety of options to manage liquidity with T-bills, floating rate treasuries, cash in your mattress. We don't really care, quite frankly. What really matters is how much exposure do you have to these three asset classes. And then if you want to run a customized version of KISS, you can drill down from there. We have a lot of investment advisor clients drilling down from there using these percent of a maximum exposure guidelines as their kind of, overarching, portfolio management technique.
All right. So a couple of things. So basically, the KISS model is about as long as it can be right
Correct.
now, correct?
Correct. Yep.
Okay. So I guess in the question of are you still a raging bear or are you more bullish? It sounds like you're pretty bullish right now.
Yeah, absolutely. I'm whatever KISS is. I use KISS to manage my entire liquid net worth. We have many clients around the world, thousands of clients in 80 plus countries around the world using KISS to manage a substantial portion of their retirement assets as well. And so I want to say KISS has been fully invested for about a month now. It was, probably 60, 70% invested, 75% invested, starting around, kind of mid to late, early May. Early May, I think, is when KISS, finally broke out and really started to cross that 50% threshold in terms of being invested in. It's just been a great ride. I mean, and I don't say this to brag or, humble brag, but, our track record and client testimonial speak for themselves. So you don't really need me to hop on this program. What people want from me is where market's headed from here. So let's unpack that.
We'll get to that in just a second. A couple of things I just want to reiterate for folks. One, this model does what it does, right? This doesn't reflect Darius Dale may wake up in the morning and have a strong gut feeling about something. That doesn't impact KISS, right? KISS is simply the empirical output of all the data that you have here, right?
100%. Yeah, there is no fundamental human element override at all with the regards to our KISS process. Like I said earlier, it is the only thing that impacts KISS in terms of the exposures that our clients feel with regards to this pie chart and these percentage of maximum exposure bar charts are the top down and bottom up risk management overlays. And so the top down risk management overlay incorporates volatility targeting to the strategy using our market regime nowcasting process. Are we in a risk on market regime or are we in a risk off market regime? Yeah. And then our bottom up risk management overlay incorporates dynamic position sizing into the strategy. Is our stocks, gold, and or Bitcoin, bullish from the perspective of their own volatility adjusted momentum signal? Are they neutral or are they bearish? Because those have different implications as it relates to the percent of the maximum exposure that you're going to have, and the ultimate size of the maximum exposure. The target allocation will go up or go down based on whether or not we're in a risk on or risk off market regime. And so, it's a dynamic process that is, obviously takes a lot of data and computation to guide these systems. But again, these are the types of systems that many of the top hedge funds across global Wall Street are using to manage not only, their master portfolios, but all the feeder portfolios that feed into these, these pot shop type strategies.
Okay, great. And I just want to make sure too that people know you always want to look for somebody who's making a recommendation or whatnot to know that they have skin in the game.
Oh yeah.
All your skin is in this game, right? 100% of your financial wealth is in the KISS model, right?
Yeah, 100%. 100% my liquid financial wealth. Obviously, I have
Yes.
private assets and whatnot. So, but yeah,
Yes.
anything that can trade is in KISS, 100%.
Okay. All right. So as KISS goes, as KISS rise and falls, your fortunes rise and fall just along with anybody else that's trading like this.
100%. And one thing I'll finally say, since we're unpacking KISS, most people certainly when they get across a certain age threshold, based on the barrage of marketing that they've been receiving from legacy Wall Street over the past few decades, with these ridiculous pie chart and target date fund allocations that, in our opinion, are not great products for the consumer, but great products for the people selling them. In our opinion, there's a sort of natural apprehension if you get past a certain age to, okay, I don't want to be, only long stocks, only long Bitcoin, only long gold, because, bonds are quote unquote safe. But the reality is, if you wanted to compare KISS to, Wall Street's, quote unquote safe pie chart, the one that, creates the least amount of the minimum amount of legal risk for them and their advisors, the 60-40 portfolio, you're talking about an average annual return for the 60-40 portfolio of only 10%, which compares unfavorably to 24% for our KISS strategy, which in the life of this rolling out of sample back test, which begins in January of 2018, whereas the max drawdown for the 60-40 portfolio is almost twice as big. It's minus 22% versus the lone double-digit drawdown in our KISS strategy of minus 12%. And oh, by the way, you would have crashed twice in the 60-40 portfolio since January of 2018, whereas you would only have suffered that lone double-digit drawdown of 12% following our KISS strategy. So, KISS has an upside capture ratio of about 250% ish relative to 60-40. So you're getting 2.5 times the return, but only 54% of the risk. And so, in our opinion, this is, I think we're going to change the way the average retail investor invests. They don't have to be a client of 42 macro. We're got a wink, wink, nod. There might be some products coming out down the pike. We'll talk about those at a future date. But the reality is, I just think there's a better way for retail investors to participate in financial markets than I think the legacy products and the legacy techniques and strategies that they've been, kind of accustomed to. The reality is it's not producing the kind. We can see it in the retirement statistics and all the surveys that it's not producing the results that people want. And so this is me coming from, the upper echelon of Wall Street to create solutions for that big problem for society.
Which is great. And we have time. I want to dig into that at the end of this discussion, Darius, because as you and I've talked about, a lot in your previous appearances, this is a real mission for you. You're really trying to bring the best of what Wall Street can offer down to the average investor, which is something the average investor hasn't been able to benefit from, until really now. And yes, you cut your teeth at the upper echelon in Wall Street. Very smart guy, very clear to anybody watching this, who is bringing this level of sophistication to the masses. But you also started from very humble roots, and I want to get into your origin story if we have a little bit of time here at the end, just so folks know exactly why you're so motivated by all this. But that being said,
I'll give you the 10 seconds. We don't even have to get into it. Look, I grew up sleeping in vans and homeless shelters and motels. And when you make it in life, coming from that background, you develop a deep sense of caring about other people and wanting to make the world a better place.
Right. And wanting to give
quite
back.
Frankly, I just got sick of making rich people rich. That's all I did for first 12 years of my career. I took the current set of rich people, applied my knowledge and skill set to their portfolios, and made them more rich. And that was great. I made myself a lot of money in that time period, but I didn't really change. I wasn't doing anything to help regular people and Main Street and the people that I left behind, sleeping in those homeless shelters, in those vans, and in those motels. And so the reality is, the reason 42 macro exists is because I'm sick of just only making rich people rich. I want to also make regular people rich too, with the skill set and mission that we have here. So that's it in a nutshell. It's really not that complicated.
All right. Well, it may not be that complicated, but it's very honorable. So I'll save the Mutual Admiration Society until we're wrapping things up here. But very important, Darius. You always gain more and more love and appreciation and fandom when you come on this channel. I think you just notched that up by another order of magnitude there for well-deserved reasons. All right, we're going to get to your future outlook in just a sec, but real quick, go back to the main KISS slide there.
Oh, sorry, my apologies.
That's okay. That's okay. I just want to flag this for people. So KISS I think for a lot of people, especially people who are watching this channel, who have been, many of them have been DIY investors their whole lives, right? Their portfolios are, I'm going to guess, a lot bigger than just 4 inputs.
Right.
And so they look at this and they just think, this can't work that well, right? It's too simple, right? Um, so, it is just 4 ETFs there that you're trading in and out of, more or less. Um, Paul Tudor Jones, one of the greatest investors living today, billionaire, I believe, um, he basically was interviewed on one of the main financial channels recently and basically said, I think going forward is a portfolio that's exposed to stocks, gold, and Bitcoin is going to be the key to success going forward. I mean, he basically said, y'all should do 42 macro.
That's too kind, man. No, look, I have a tremendous amount of respect for Paul. I've met many of his PMs over the course of my career, and he's a great man and does a lot of great things from a philanthropic standpoint. And so it was really humbling to see, someone I've looked up to my whole career, as to your point, as one of the top investors in history, not just of our era, in history. You put up his returns with anybody in the macro space, and his trading acumen. He essentially arrived at the same conclusion that we arrived at years ago in the context of our investing during a fourth turning regime analysis that you and I have discussed over the past couple of years on this presentation, which is, hey, I think the key conclusion of that presentation is there is a growing geopolitically driven supply demand imbalance in the treasury market. You have a lot of external forces that are reducing the amount of demand for treasuries, while you have a lot of internal political forces that are increasing the amount of supply. And as long as that's the case, what's likely to happen is the bond market will continue to make higher lows, lower or higher lows and higher highs in terms of yield. We're in a secular bond bear market, but ultimately that secular bond bear market is likely to accelerate and become exponential in terms of the price decay. And eventually the Fed is going to have to step in and fill the void in terms of this supply and demand imbalance. And so what KISS does is it orients our portfolios, my portfolio and our client portfolios, to the right assets, to the right asset classes, to the right exposures that will take advantage of the eventual Fed filling of the void in this growing geopolitically driven supply demand imbalance in the treasury bond market. And so obviously you're going to need to risk manage this. These are 3 quote unquote risk assets. I don't believe they're risk assets in a fourth turning poly crisis. These to me are the defensive assets. The risk assets are the treasury bonds and the US dollar that everyone needs to get out of because of the growing geopolitically driven supply demand imbalance in that market.
So that makes total sense to me as sort of a long-term thesis, right? Okay, when that crisis, really builds up steam, you want to be in these assets here, but they seem to deliver great results in the near term too.
Can I make a correction?
Absolutely.
Not while the crisis is building up steam. When the crisis is building up steam, you're going to want to be in cash. And that's the whole point of KISS, is it gives you the opportunity to take advantage of what are likely to be exponential moves higher in these assets over concentrated periods of time that will be ultimately interrupted by some very serious, significant capital destruction as a function of, the void getting bigger, right? Eventually the void will get filled, but there will be times where the void gets bigger and the Fed isn't monetizing fast enough. They're not performing enough financial repression. And so this chart right here, essentially, it's a great snapshot of what you should expect to happen as an investor. And this is not just me doodling on the page. There are hundreds of slides of empirical research with time series that span back to the 1800s that help us and our clients arrive at these, fourth turning poly crisis conclusions as it relates to what you should be doing in your portfolio. And the reality is, as a function of all of the dynamics that tend to happen in fourth turnings from a fiscal policy perspective, geopolitical perspective, economic perspective, and ultimately monetary policy perspective, you should expect more, a faster rate of a price appreciation in these types of, quote unquote, legacy risk assets, stocks, gold, Bitcoin. But ultimately, the drawdowns in between the bull phases will be more severe than they typically are because, again, there's a larger structural force of capital destruction going on in the background from the perspective of the treasury bond market. So you're going to have these wild asymptotic swings, much like what we saw here in 2025, very clearly like what we saw in COVID. I think we saw, somewhat of an extended version of that from 2022 up into the highs of 2025. So just get used to more volatility in financial markets with bigger returns. And so to me, all roads lead back to you need to have institutional grade risk management overlays to navigate this. If you think you're going to trade your way through this, I guarantee you, you will not retire on time and comfortable.
All right, and so, maybe this is overly simplistic, but I may be correct here. Is the whole so as the prospect for treasuries decay, risk assets are going to appreciate at a faster trajectory than historically, but with more volatility. And so what KISS is trying to do, or its mission is, we're going to help you catch those more violent upswings, and we're going to get you out of the pool, hopefully in advance of the more violent downswings.
Yep, correct. 100%. And this, let me erase this and just kind of draw exactly what you said. As an investor, what KISS does for you is it says, hey, give me, I don't know, let's call it 80 to 90%. And technically speaking, the upside capture ratio is 90% relative to a naked long portfolio of stocks, gold, and Bitcoin. Give me 80, 90% of the upside while only giving me 50% of the downside.
Yeah.
So you see what I'm drawing here?
Yep.
And if you collect the shaded boxes and stack them up together over time, what's going to happen to your portfolio is you're going to wind up compounding returns from a higher net asset value in every subsequent market cycle than you would if you just hodled all the way down to the lows. And so this is the secret. This is Wall Street's dirty little secret, which is they sell you products that force you to onboard volatility drag into your portfolio, target date funds, pie chart asset allocations, all this boring manila nonsensical stuff that's quote unquote safe. But the reality is you're just providing liquidity to the strategies that they use to avoid the volatility drag they're selling you via these products. And that's why KISS exists, is to give people a life raft to stop that process and really speed up their on time and comfortable retirements.
Okay. It's great. Every time I talk to you about the model itself, Darius, I feel like it's just this infinite onion that I always feel like I understand it a lot, but I always learn more about it than each time that you're on, and have an increased appreciation for it. Okay, so that's the model. Let's get to the data.
Sure.
I mean, there's a lot going on in the world right now. We certainly have all this geopolitical instability. I guess we'll talk about that in just a second, but I guess, how do you evaluate or assess the current market activity right now?
Yeah, well, we're currently in a risk-on market regime according to our model. So what we do, I think I might have explained this in a previous episode, so I don't want to be too verbose today because I know we got a lot to cover. But one thing we do on a daily basis for our clients is we now cast the market regime. I would say it's probably the most important thing we do certainly for our institutional clients, and obviously because of KISS for our retail clients as well. And so we're now casting the market regime. We see that 23 of the 42 markets that we are scoring vis-a-vis our volatility just momentum signal relative to how those individual markets have historically performed in the various market regimes are currently confirming Goldilocks. That's 23 out of 42. It's at the highest sum and highest share. So as long as we're in Goldilocks, KISS and Dr. Mo, which is the system that we built to keep our institutional clients on the right side of factor risk, so essentially KISS, but across 70 different factors, that model is oriented to Goldilocks. And so until that changes, you would expect me to be bullish. I will sound bullish, and ultimately, generally speaking, the performance of our KISS and Dr. Mo strategies will reflect that.
Okay, so when you have an environment like this, and then you have, big non-market events that could impact the economy or markets, and let's just use the outbreak of hostilities between Israel and Iran. How, if at all, does that factor in here?
Yeah, great question. Excellent question. So to me, when you're talking about, I would say, non-modelable dynamics, things that don't have time series but will have impact on financial markets, you always got to go to the unit root of how will it impact financial markets, because unless there is some connective tissue that that traces back to investor positioning, it's more just news. It's just it's noise. It's noise. It's not news.
It's not signal. It's noise. Yeah.
It's not signal. It's noise. And so whenever you're thinking about evaluating anything as it relates to global financial markets, you have to think about, how does this impact one of these 6 cycles: growth, inflation, monetary policy, fiscal policy, liquidity, and positioning. And in my opinion, positioning is really just an amplifier for inflections in the trends of those other cycles.
Mhm.
There are times where the growth cycle is really prevalent. There are times when the inflation cycle is really prevalent. There are times when the monetary cycle is really prevalent. There are times when the fiscal policy cycle is really prevalent. And ultimately, there are times when liquidity overwhelms everything, like what we saw in Q4 of 2022. So I think it's important for us as investors to have a robust enough research process to know exactly where we are in those cycles at any given time. And there's a dirty little secret here. So many people who do what I do, both on the sell side and on the buy side, they spend so much time forecasting where they think we're probably going to be on those cycles, and not nearly enough time just rolling up their sleeves and crunching the numbers on a day after day after day after day basis to figure out exactly where we are in the cycles, because there's a tremendous amount of signal in knowing where you are, because these cycles rarely ever jump condition. There's usually momentum in these time series when you're talking about those big key macro cycles that matter.
Okay. And I guess back to being in Goldilocks right now, we rarely wake up one morning and we were in one phase and then we're in the next, right? There's momentum. You can kind of see the shifts as they start to happen, right? What does your experience tell you right now, given where the indicators are? Like, are we thick in a Goldilocks, meaning it's going to be a while before this thing shifts into a different phase, or are we seeing any signs that a turn, could be approaching?
Yeah, it's a phenomenal question. So most of the movement we've seen in Dr. Mo across the various factors in recent weeks has come in getting incrementally longer of treasury duration type risk, whether it be 5 to 10 year treasury or 7 to 10 year treasuries, mortgage-backed securities, investment grade credit. There seems to be a broad dovish tilt with regards to fixed income. Now that could be the start of a potential roll phase transition to risk off deflation. So Goldilocks is risk on with the disinflationary bias. Deflation is risk off with the disinflationary bias. And so in Goldilocks, you want to be taking credit risk and illiquidity risk and pushing yourself out on the risk spectrum. In deflation, you want to be doing the exact opposite, but also being mindful of those risks. Now, obviously, you have crude oil, and commodities, long max position, ags at a long max position. So there's clearly some inflationary impulse, the markets are picking up on as a function of the Israel-Iran conflict. But broadly speaking, this has been the case for a while now. And so, perhaps this is the market saying there could be a stagflationary slowdown in the economy, and in a stagflationary slowdown where the Fed has I would not say egregiously asymmetric, reaction function, but in our opinion, it does have a dovish reaction function. In a scenario where the Fed has a dovish reaction function, that if inflation goes up and growth goes down, the Fed is going to anchor more on the growth side of the mandate and probably cut interest rates. And so that may be what the markets are pricing in at the current juncture. And by the way, that dynamic can keep you in the Goldilocks. If we don't slow fast enough, which by the way, there is a reasonable probability that we don't, at least according to our grid model here, if we don't slow fast enough, what you could wind up with in terms of reported data relative to consensus is a period of persistent upside surprises on growth. And if that is the case, you could, in theory, persist in this Goldilocks market regime over a much longer time horizon than I think the average investor realizes in the context of that dynamic, but also in the context of the monetary and fiscal policy dynamics that we've identified for our clients back in late April with regards to our paradigm C thesis.
Okay. The model is going to do what the model is going to do, right?
Correct. I don't tell the market regime nowcasting process what to do. I don't tell our volatility just momentum signals what to do. They're just incorporating new data, crunching the numbers, and spitting out the output. And I'm responding.
Exactly. But you, Darius Dale, the just individual who reads a lot of news, looks at the economic data and whatnot. Where do you think the risk is on economic growth? More to the upside for the reasons you just mentioned, or more to the downside?
Yeah, in our view, it's highly likely to be more to the upside. So for starters, our grid model, which is a better track record of predicting growth from a first difference standpoint than Bloomberg consensus, which again, there's a lot of, I don't want to say that, but never mind. It's a slightly better track record of predicting the first difference in growth than Bloomberg consensus. In our opinion, that's one starting point. So we would never base a fundamental research theme on a model-based conclusion. All of our fundamental research themes are based on first principles relationships in the economy that we identify faster than other investors. In one relationship in the economy that we've identified, or at least one thing that we think is likely to be very impactful for the financial markets, is the fact that consensus currently has this very elevated implied recession probability. It's currently at 40%. It was at 20% to start the year. It typically hangs out around 10 to 15%. So essentially, the consensus implied recession probability could get cut in half twice to get to a normal level. So let's ask ourselves, why is it at such a high level, and why do we think growth could potentially surprise to the upside over the medium term? Right now, there's a tremendous amount of
tariff concern. Yeah,
concern, and there's a tremendous amount of uncertainty with regards to the future policy outlook. Yeah. And this is reflected in the Baker-Blumen-Davis index. We're essentially at an all-time high as we were at the height of the GFC, as high as we were at the height of COVID, currently right now, and have been there for a couple of months. So obviously that's applying downward pressure on the economy. I think the risk that investors are missing is that this, at some point, policy will become more clear and less certain. And I think there's a large, I don't think we can observe this in our positioning model with empirical time series. We can very clearly see that investor consensus is not fully positioned for policy uncertainty resolving with good policy.
Right. And sorry, you said more clear and less certain, but you meant more clear and more certain.
Sorry, right? Yeah, my apologies. Thank you.
No worries.
More clear and more certain. Eventually, in the next, let's call it 3 to 6 months, policy will become more clear. And in our opinion, it's going to become more clear in the direction of positive upside surprises to growth. And one final thing I'll say with regards to the upside surprise to growth is, if you look at so we track this metric here, 42 macro, called the consensus short run potential real GDP growth expectation. So that is the average of the current year and next year real GDP growth expectation from Wall Street consensus. So it's essentially, if you remove the impact of base effects, what do Wall Street's top economists think the economy can just generally grow at over, a short, investable time horizon? And right now, we went from, if you took a snapshot of that, the height in February, it was at 2.2%, and they cut that all the way down to 1.5%. So we lost some, close to 40% of our, perceived growth, or 35% of our perceived growth, potential growth, according to Wall Street consensus. We think that is a way too big of a negative haircut in the context of what is likely to be a materially positive fiscal impulse starting in 2026. And so, in our opinion, at some point between now and let's call it this time next year, markets are going to have to capitulate to the upside on these ridiculously low growth expectations, which will drag earnings expectations higher and market multiples higher, credit spreads lower. And this is how you wind up with an explosive bull market on risk assets. And by the way, we've been calling for this since May 3rd of 2025. So I just want to make sure everyone's aware that, this view has been ongoing.
Okay. All right. So you think that odds are more likely that tariffs are going to be less of a drag on economic growth. So economic surprises are going to be the upside, and for the reasons you just said, eventually stocks will get the memo and risk assets will go higher. Let me ask you this, since we're on tariffs. I heard you mention the potential for a stagflationary period. Not that you're necessarily calling for it, but if you are, clarify. But we still have not seen too much materialization of the tariffs that have at least been slapped on so far, reflecting in higher prices. So far, at least, it seems like the corporations are eating the majority of the impact so far. What do you think is likely to happen inflation-wise, more likely to happen inflation-wise going forward?
Yeah, I'll tell you what the high probability outcome is, and I'll tell you what's been happening. And those are two very different things. Okay. So we are forecasting stagflation. In our nomenclature, that's what we call inflation. That's growth trending lower and inflation trending higher. And so we have that condition forecasted from April all the way through December. That is consistent with what Wall Street is forecasting as well. They're also forecasting April through December in terms of inflation. So we're right in line with consensus in terms of the delta on growth. And the delta in terms of the overall snapshot for the economy with regards to growth and inflation. But what we're most divergent starting in the second half of the year is on growth. Our model thinks that growth is likely to surprise to the upside. And I have a litany of fundamental reasons why that's likely to take place. One, you don't have the economy. Recall that you and I have been discussing our resilient U.S. economy theme that we authored back in the summer of 2022. That theme has allowed us to sort of at every interval stiff arm the consensus recession expectation. You go back to the summer and fall of 2023, you go back to the summer of 2024, and you come right to today. We continue to anchor on that theme and all the drivers of that theme as a reason to, in real time, stiff arm the consensus recession implied probability. So supporting our resilient economy theme, which again has been ongoing for almost 3 years now, is the persistency of very strong private sector balance sheets. We can unpack the various metrics there. You also have labor hoarding, partially as a function of demographics, but also as a function of the change in border policy that's ongoing. We have deregulation in terms of not only in terms of deregulating the energy sector, the housing sector, but I think that one of the biggest avenues for deregulation that's going to touch every sector of the economy is the deregulation of the financial sector that will be ongoing throughout this administration, and we are likely to see a pull forward of that before year end. And then one final thing, you have tax cuts. Some of the tax cuts, particularly the ones that impact consumers, are going to be retroactive to Jan 2025. And so once people start, once the tax bill gets signed into law, people are going to feel a little bit more comfortable to take down their savings rate in anticipation of having a higher disposable personal income.
Mm-hmm. Okay,
we can unpack any of that if you would like.
Yeah. So does that mean, I'm just trying to use your terminology here. Does that mean you expect as we get into the latter half of the year, we'd actually be more in reflation, where we'd be growing faster than the inflation rate?
We could, yes, we could. I think so. I think that is a reasonable estimate. I mean, generally speaking, if growth is surprising to the upside while inflation is accelerating, then yeah, you're probably the highest probability market regime to price that dynamic in is reflation.
Okay.
I could see a scenario
which is still positive for risk assets, right?
Yeah, exactly. I could also see a scenario where Goldilocks is reasonable as well. Goldilocks is the current regime. I could see a scenario where Goldilocks generally, is the modal outcome regime market regime between now and let's call it year end or this time next year, 6 to 12 months. And the reason for that is growth is still slow. Let's not forget we smooth hauling tariffed ourselves to a level of tariffs that again, it's commensurate with the legislation that kind of made the Great Depression much worse than it had to be. It was going to be a Great Depression anyway. We had a significant contraction in the money supply, but guess what? When you have a significant contraction in the money supply because of banking calamity, you don't want to layer on top of that a significant tax increase, and that's exactly what happened in Smoot-Hawley. So there will be a slowdown in growth, partially as a function of tariffs, but also as a function of the elevated policy uncertainty that we have. But the reality is, in our opinion, the goods sector, the manufacturing sector, consumer spending on goods, they're just not big enough as shares of the economy to tank the entire economy. And as long as you have buoyant capital markets supporting the, I would say, confidence of rich people at the top part of our K-shaped society, which account for the vast majority of consumer spending, as long as they feel comfortable to keep spending, particularly on services, which is by far the lion's share of the economy and consumer spending, then things should be generally fine. So we'll slow, but we'll continue to maintain a positive growth rate. In fact, our model has real GDP growth coming in at 1.3% year over year on a Q4 over Q4 basis. That's at 40 basis points higher than the Bloomberg consensus for 2025.
Okay. All right. So that's your optimism right there at 42 macro versus consensus. Okay. So I want to ask you a macro question in a moment that's going to try to poke a little bit of a hole in
Sure.
growth optimism. Before that, though, so again, if I understand everything we've talked about, you are on the balance more optimistic in the second half of this year than consensus, right? And that's for all the reasons that you've just described here.
And over the course of the next year as well, looking into 2026 as well.
Okay, well, my question's going to get into that, which is so how much of that getting into 2026 is around this administration's economic policies? So I want to get a sense for your general, the last time we talked, Trump administration was still super new and we weren't exactly sure what they were going to deploy. Now we've got a better sense of it. It's all about trade, taxes, deregulation, as you mentioned. So if the administration is successful in deploying those policies in the way that it wants to, Does that make you more or less optimistic about our economic growth policies over the next couple of years? And then in your answer too, when do you think we'll start seeing the first green shoots of that?
Yeah, excellent question, Adam. Excellent question. So I think it's important to contextualize our the starting point with regards to the U.S.'s fiscal situation. The solution to that, at least the solution that's being currently worked on by the administration, and then ultimately to answer your question, how will this impact? How's this likely to impact the economy? And then the bonus answer is: are people positioned for the the highest probability outcome? But
Right.
the spoiler alert, no, was the answer. So let's start with the U.S.'s fiscal situation, which is one of the key conclusions again of our investing during a fourth turning regime deep dive empirical study on hundreds of years of data, trying to identify exactly what happens in a fourth turning from the perspective of the economy, fiscal policy, monetary policy, and geopolitics, and ultimately what does that mean for investors. One of the most important conclusions is that you have this runaway growth in the size of the public sector balance sheet for a variety of reasons. To begin the process, it's a function of populism, and then to end the process, it's usually a function of total war. And so we are certainly knee deep in the populism part of the movie, and you can see this as evidenced by our fiscal policy dynamics. If you look at our public sector debt to domestic liquidity ratio, so we aggregate so you're familiar with our work on global liquidity. We also aggregate liquidity at the various country levels and then sum that up to our global liquidity metric. And so our global liquidity metric is the aggregated sum of the global central bank balance sheet plus global broad money supply plus global FX reserves minus gold. These are all the three main pockets of liquidity that are sloshing around financial markets. And then when you look at that from a domestic standpoint with regards to the U.S.'s public sector debt is 114% of its domestic liquidity. We have more debt now than we have liquidity to capitalize. So obviously we're in this desperate, kind of need for foreign capital, and will be for an extended period of time. And just to give you by way of comparison, that 114% compares to 68% for the world, of which the U.S. is included, 61% for the Eurozone, 61% for Japan, and 31% for China. So we're essentially like a double of our peer economy, debt to liquidity. With regards to the debt to liquidity ratio, we're essentially a double of our peer economies. And so,
and not in a good way.
And not in a good way. No, you don't want to be a double. You don't want to be a double. The U.S. is about 35% of all public sector debt globally, and that's up from a low of 24% back in 2023. So, we're moving in the wrong direction at a very expeditious pace with regards to these debt dynamics. And the problem with that is, if you want to check out our fourth turning analysis, I would highly recommend. But the key takeaway is there are reasons for the rest of the world to now stop capitalizing our bond market at the margins. And so that leaves us with, footing the bill to pick up the slack. Ultimately, the key takeaway is the Fed's going to be forced to pick up the slack. But in the meantime, there are levers the fiscal policymakers can pull. So the first lever, which we just learned that is they're not going to do anything. They've essentially punted on the first lever. The first lever is cut. You try to cut your way out of the profligate spending that the Biden administration soured us with regards to the 24% expenditure to GDP ratio. That's up from a long run mean of about 20%. So we're like 400 basis points north of the long run mean in terms of our spending as a share of GDP year after year after year until they legislate it down.
Right. And the long-term mean wasn't something to aspire to either.
No, 20% is higher than the long run mean of tax receipts as a percentage of GDP of 17%. So, we've had this long run persistent budget deficit of 3%. But obviously in recent years, it's been closer to 6-7%. And so on the spending side, on the cutting side, we obviously have the one big, beautiful, one big, ugly bill working its way through Congress. In our opinion, there's hardly any spending cuts in that bill. There's about $1 trillion, a little bit somewhere around $1 trillion, give or take. So we'll see what the Senate comes up with. But the reality is that they're cutting spending less than they are reducing their revenues relative to baseline. And so ultimately, you're probably going to wind up with a bigger deficit. At least that's what all the conventional scoring models, CBO, Pinwart model, my alma mater, Yale Budget Lab, they're all essentially coalescing around an additional $2.8 to $3.5 trillion in incremental debt. But on the spending side, we know Doge is essentially Doge is done. Doge is toothless. I mean, Elon bowed out at about $175 billion. I told you guys on this program in the fall that they're not going to find $2 trillion of fraud, raised abuse in the government. They're going to have to do some real serious soul searching if we want to actually shrink the government. And I said in this analysis, even if Doge cut 100% of non-defense discretionary spending, and float that all the way down to the bottom line with no impact on tax collection or the economy, you would wind up with a $1.5 trillion budget deficit that was worthy of about 5 percentage points of GDP, down from 7. So again, if Doge cut 100% of non-defense discretionary spending, which is about 15% of total outlays, you would have wound up with a 5% budget. Well, we know Doge isn't going to cut anywhere near that. So let's move on to the second potential solution with regards to paradigm C, and that's growth. So paradigm C, if you kind of go back to what we essentially, we've been thinking about the world in this paradigm C framework again since I want to say April 23rd is when we authored the view. May 3rd is when we fully, got, fully invested according with that, I want to say. And so the key takeaway for paradigm C is, okay, if we're not going to cut our way out of it, then we can try to grow our way out of it. And you've heard Treasury Secretary Scott Bessent call for this. You've heard White House Counsel, Chair of the Economic Council, Steve Moran, call for this. You've heard Kevin Hassett call for this on the Economic Council as well. And so the key takeaway is, okay, we can't cut our way, so let's just try to, create tax cuts and try to grow our way out of this mess as fast as we possibly can. And so they're going to do that. And here's how they're going to do that. One, they're going to, increase deficits. If you look at the House passed one big ugly bill, you're talking about a positive increase in the primary deficit, somewhere close to, some estimates. Committee for the Responsible Federal Budget has the estimate of around $500 billion. The Penn Ward model has that over $600 billion. The Yale Budget Lab has somewhere around $400 to $500 billion. You're talking about a significant positive shock to a positive fiscal impulse starting in 2026 that may drag into 2025 once you consider the retroactive nature of some of the tax policy changes with regards to the consumer, to the household sector. So that's one way they're going to try to grow out of it. Another way they're going to try to grow out of it is by forcing the Fed to implement a regime of persistently negative real interest rates. You've heard President Trump, essentially all but call for Fed independence, for the removal of Fed independence, and Jay Powell himself to essentially legislate this. In our opinion, based on what we talked about earlier at the beginning of the presentation, we think this is the single greatest upside risk to asset markets that is not currently being discussed and certainly not being factored in or priced in, is the fact that the Fed, which is currently now, according to its dot plot, targeting 2 rate cuts in 2025 and 1 rate cut in 2026. I think at minimum, you got to double that in terms of the pandering, dovish sycophant that is going to replace Jay Powell as Fed chair. We know President Trump, we've seen a pattern of this now for his previous term in office. We saw it while he was, tweeting about the election being stolen for 4 years. And now we're seeing it again. He surrounds himself with pandering sycophants that execute his mission. They don't bring in their own ideas. They're there to rubber stamp his mission. And so we know that whoever he selects at the Fed chair, certainly after this experiment with Jay Powell has gone so horribly awry from his perspective. Recall that he appointed Jay Powell Fed chair, assuming that he'd probably be able to tell Jay Powell what to do. The reality is Jay Powell has got some big cojones, to say the least, to stand up to the president of the United States. But the reality is whoever he gets replaced with, and which may come pretty soon, by the way, he's going to name a Fed chair in waiting, he said already. That person is probably highly likely to be one of Trump's collection of pandering sycophants that are there to implement whatever policies the commander-in-chief wants. And the reality is the commander-in-chief wants dramatically lower interest rates, both nominal and real. And that's not at all priced into US dollar money markets. The floor Fed funds rate, if you look at the minimum value on the overnight index swap curve out 5 years, is about 3.25. I think you can take that at least down to 2.25, probably even 2 if they get really, jiggy with it. They want to get jiggy with it, they might ahead of the midterm elections. So that's going to be another avenue, the lever they pull to try to spur growth. And one final thing, I'll let you ask a question here. I know I'm talking
but that'll be a big lever, right? You said that's the biggest. You see that as the biggest.
It's the most underappreciated risk relative to investor consensus current position. Is the fact that Jay Powell is highly likely to be replaced by a pandering sycophant that puts blinders on and ushers in an era of persistently negative real interest rates. And then the final thing, there's a couple other things, but the final big thing that I think we know the administration has already told us they're going to use to try to create this economic boom that tries to help us outrun the debt to GDP ratio accumulation is deregulation. So we're going to see deregulation in the financial sector. I think that's the biggest form of deregulation there is. Not enough people are talking about it. They're already talking about lowering the SLR, the supplementary leverage ratio, by a broad 1.5 percentage points, not just scrapping it for treasuries, but lowering it broadly so we can lend to all sectors and segments of the economy. Michelle Bowman's talking about taking small and community banks, which are like a third of total credit lending, giving them their own regulatory framework that will allow them to expand for the first time. And then you're seeing headlines like this, Wells Fargo violated the law again last December, and the Trump administration immediately upon coming in office took them out of the penalty box, even after they violated the law last year.
Yeah.
So we know we're going to get a lot of deregulation in the financial sector, and that's going to have huge ramifications for the broader business cycle because we have not had a self-sustaining credit cycle here in this economy since 2007. That's a huge upside risk to economic activity, not just in 2025, but over the long term, relative to very subdued consensus expectations that are essentially calling us to muddle along.
Okay. So the collective impact of this, it sounds to me, is good for the economy. It'll juice the economy for some period of time. Now there will be a piper that needs to be paid, but that's getting pushed off into the future, which is Washington D.C. 101, right? So we'll get greater economic growth, so corporate earnings will go up, and therefore financial asset prices should go up. We're also going to have probably lower cost of capital, especially once, if indeed a yes man gets put in at the Federal Reserve, and lower interest rates generally mean higher risk asset values too. So you basically have a number of these factors that you just walked us through, highly likely to juice risk assets going forward. So Darius, you talked about in kind of a fourth turning era like we're in, risk assets, their general trajectory is higher than normal, more volatility, but it's higher. But with these things, we're kind of even increasing that trajectory even more, right?
Well, this is all part and parcel to it, right? The reason
Yeah.
trying to pull all these levers to engineer an economic boom is because we're in this mess to begin with. And it's a lot more politically pleasing and palatable to engineer an economic boom to get your way out of, or at least attempt to get your way out of a debt mess, a debt bomb, than it is to, cut your way out, right? The cutting is the more legitimate solution, and certainly would be interpreted as the more legitimate solution for the bond market because it has the highest probability of being durable. And on that point, with regards to durability, I think there's one thing we need to talk about with regards to these our friends on the Republican Party. Their tax cut, their record on tax cuts is not good in terms of creating sustained, durable, positive shocks to growth. They do historically create, let's call it a positive shock to growth that lasts 1, 2, sometimes 3 years. But when you look at it on a 4 or 5 year basis, in terms of having any impact on the trend of economic growth, the reality is no. The trend continues to be lower in every instance. When you look at the Reagan's 81 tax cuts, Reagan's 86 tax cuts, the 2001 Bush tax cuts, 2003 Bush tax cuts, and the 2017 Trump tax cuts, the trend growth continued to decline in the subsequent 5 years every single time in one of those in those instances. So I think investors need to be aware that we're going to have this sugar high because that's the most politically palatable solution, is to create the sugar high and sell it as if it's going to be a durable positive shot to growth that lasts 10 plus years. But the reality is it's probably not, right? And so ultimately we're going to be wind up back at the same place where we started, which is a ticking debt time bomb. And again, I'm not somebody who's, this isn't Stansberry researchers banging the table to buy gold since the 1980s because of the debt deficit. This is not what we're doing here. What we're doing here is connecting the pieces of the puzzle together. This is a 10,000 piece global macro jigsaw puzzle that requires you to have a deep understanding of fiscal policy dynamics, monetary policy dynamics, economic dynamics with respect to growth and inflation, and also with regards to geopolitical dynamics. And those 4 pillars of global macro understanding with regards to our investing during the fourth turning regime framework, when you put those 4 things together based on our current starting point, we're going to wind up with an even worse debt and deficit situation that we had. Now, again, I'm not trying to fearmonger about the debt deficit. I don't care about the debt deficit. What I care about are the policy responses to the debt and deficit. And right now, the policy response is to create an economic boom. Eventually, the policy response will be to use the Fed's balance sheet to step in and fill that void. And both of those things, both of those dynamics, whether it be paradigm C or the eventual filling of the void by the Fed, both of those outcomes are incredibly bullish for, you guessed it, stocks, gold, and Bitcoin.
All right. So let me just distill all this down then. So it sounds like you feel, or not feel, you calculate that the rest of this year will probably be pretty okay. Look, there's always going to be volatility in here, but it's probably going to be pretty okay, maybe even better than consensus expects right now on the street for risk assets, or the assets that you hold in the KISS model, right? Um,
Let
sounds
me
like you think,
can I
pardon me?
confirm or disconfirm that? You give
Yeah,
me a checklist and I'll say yes or no and correct where necessary. As a matter
sure.
of fact, let me just draw a stylized diagram of what we expect. So this is the economy here, this line that I'm about to draw. This is essentially what we're calling for from the economic standpoint, with the nadir probably being Q3 or Q4. I have no
Got it.
clue if it's Q3 or Q4. That's the economy. The
Yeah.
markets did this. V bottom, we're
Yep.
here. There's a chance we chop around because we have tariffs and congressional brinksmanship and Israel, Iran, and some other scarecrow pop out of nowhere. But eventually, we think the probability of the next 20% delta in, let's call it, the S&P 500 is higher.
Higher.
I
Yep.
have no idea how long we chomp around this summer, or maybe even, kind of spook some people in terms of having a growth scare or congressional brinksmanship scare. Don't forget the debt limit clock is ticking. There's a lot of things in the way of achieving this nirvana associated with our paradigm C thesis. And so I don't want to say it's going to be a linear straight ride from today all the way to realizing that upside risk. But the reality is if you're playing for the big moves, the next big move is highly likely to be higher for everything that I've been talking about for the past hour, for all the
Great.
reasons I've been.
And so thank you. This is exactly what I was looking to do. Um, and the reason I really want to bring this up is that, look, there are lots of reasons to have concerns. And just full transparency, you can just look at the people who appeared on this program in the past 2 weeks. There's a lot of people who are still like, hey, I think recession risk is still, uncomfortably high. Or Lacey Hunt, looks at his macro models or his economic models and says, I think deflation is going to, really kind of win the day here and whatnot. So there's a whole bunch of reasons why investors could adopt a more negative view of the future. And I just want to clarify, your data is telling you those are probably overblown. We're probably going to end this year, better than most people think. And then we've got this 1, 2, year sugar rush ahead of us, where risk assets are going to have a real, upward pressure underneath them for all the reasons that you just mentioned.
Yes. And I'm not saying they're overblown in terms of their actual outcome. The outcome is not overblown. Congressional brinksmanship is scary. We need to have this bill passed in order to have a positive shock to growth from a positive fiscal impulse. You need it. So if it ever the markets feel like we're not going to get it, that is a problem.
Mm-hmm.
Tariffs are a problem. We're going to get barraged with this bevy of Section 232 tariffs that everybody's seemingly forgotten about, but in my opinion, are going to be more onerous upon the economy than the IEPA tariffs, the reciprocal tariffs. Because the reality is those are probably the latter are going to get negotiated away in these ridiculous trade deals that
Right.
probably won't have much of an impact on the economy. But the reality is these Section 232 tariffs are going to stick around for probably ever, right? And they're going to raise the cost of production for pretty much every industry in the economy. So you're going to put a lot of sand in the gears of the economy, and also perhaps create a decent amount of lasting upside pressure on prices as a function of that. And so there are some real legitimate problems ahead of us. Right now, obviously policy uncertainty being one of those big problems, and the impact that that likely is having on capital allocation decisions for corporate America. But in our opinion, and again, this is where the art comes in. It's not all just in terms of me trying to create a market narrative that makes our clients confident to dispassionately execute our KISS signals.
Mm-hmm.
Our estimation of this market narrative is that there is more right tail risk to price in financial markets than there is left tail risk. And the reason for that is that our positioning model indicates that the markets are not nearly as bullish as everything investor positioning is not nearly as bullish as everything I've been talking about. So let's just anchor on the positioning model time series that correspond to the medium to long-term time horizon. So in our risk management nomenclature, that's 3 to 12 plus months. Anything beyond 12 months is what we call long-term in risk management speak. And so these are the indicators that correspond. If you look at the AI stock allocation survey, the latest values in the 51st percentile, as opposed to the 85th percentile at the highs in February. The AI bond allocation survey has increased to the 54th percentile, up from 32 in the 32nd percentile at the highs in February. The AI cash allocation survey has increased to the 44th percentile, as opposed to the 16th percentile at the highs in February. If you look at realized volatility, which we use to proxy systematic fund exposure to markets, systematic funds are in the 5th percentile of their exposure because realized volatility is in the 95th percentile. We use implied volatility correlations to proxy market neutral hedge fund pod shop exposure to the markets. They take more risk when implied vol correlations are down because there's more alpha to be generated in financial markets. They're still pretty max long here, so that's not an upside risk. But if you look at valuations, we're in the 98th percentile in valuations at the highs in February. We're only 87th percentile now, so we got plenty of room there. Don't have a ton of room in investment grade credit spreads, but most of these indicators are telling you that there is upside risk to the positioning cycle. And in our opinion, based on what we can observe in between consensus estimates for growth and our paradigm C thesis, there's a tremendous amount of upside risk with regards to consensus expectations for GDP and earnings. So those two things, upside risk for GDP and earnings and upside risk to the positioning cycle, equals there's a high probability that the next delta, big delta in financial markets from a risk-taking standpoint is higher. But again, that might not occur until after we get through this summer or fall with regards to all these scarecrows that we got to price in. We could chop around between 6,000 and 5,500 till October. I have no idea if that's going to happen or not. I don't care. What I care is dispassionately executing our KISS signals. And my expectation as someone who is dispassionately executing a completely systematic process is that I expect that systematic process to make me and our thousands of clients a ton of money between now and June 18th, 2026. It's June 18th, 2025.
Great. And because of the whole risk management part of it, the volatility management part of it.
So here, let me take a step back. The reason we do fundamental analysis here at 42 Macro, because again, all of our investment conclusions in terms of what our clients should be doing in their portfolio from a risk management standpoint, they're all completely systematic. Our KISS signals, so we've now cast the market regime. We filter those signals to our retail clients via KISS. We filter those net market regime signals to our institutional clients via Dr. Mo across 70 different factors, across 5 different, or not 5, it's probably 12 or 15 different asset classes. But that's neither here nor there. The reason we spend so much time turning over every stone, analyzing every relevant time series across those 6 cycles that we highlighted earlier, the reason we spend more time than most piecing together the global macro puzzle is not because I want our clients to take, our fundamental research themes and do something in their portfolio. What I want are our clients to feel confident to make the changes in their portfolio whenever KISS and Dr. Mo signal changes. It's not my job to tell the market that it's time to price in Goldilocks, or that it's time to price in reflation, or that it's time to price in inflation, or that it's time to price in deflation. Notice that I just said the word time 4 times. It's not my job to tell the market when it's time to price in, what side of the distribution it decides wants to price in. Right now, it's pricing in the right tail of the distribution. I just talked for an hour that tells you that there's a tremendous amount of right tail risk for it to continue pricing in, but there's also some left tail risk that it may, at some point in the summer or fall, decide to price in that left tail risk because at some point the positioning cycle might get a little bit over skis to the right side. This is how markets work. I don't know when that's going to happen, but I do reserve the right to wake up and dispassionately execute all of our quantitative signals that are backed by proven quantitative techniques that have stood the test of time across global Wall Street, and signal to our clients, hey, the market is no longer pricing in right tail risk. It's now pricing in left tail risk. Make all these changes in your portfolio across the asset allocation and portfolio construction perspective. How long will this last? I have an estimate, but the reality is I don't know. No one knows. In the end, if you're trying to risk manage portfolio risk based on your estimate of a pinpoint precision forecast of how long we're going to remain in the market regime, let me guess, I'll give you another hint. You're not going to retire on time and comfortably. It's your job to be dispassionate and just participate in what the market is pricing in. And if the market is pricing in left tail risk, then just step to the sideline or raise cash or buy some hedges. But once that left tail risk period is over, you got to get back fully invested. And this is what 42 Macro clients do better than everyone. We're the only ones who in April were buying Bitcoin hand over fist, buying stocks hand over fist after nailing the crash. Recall that I entered the year saying the market was going to crash. Right. And guess what? It did crash, and KISS and Dr. Mo got our clients out ahead of that crash so that they could compound returns from a higher net asset value in the new bull market, which started in April. That's it. That's all I'm trying to do is repeat that process over and over again until I retire, till our clients retire on time and comfortably.
Great. And that's all I was trying to do is tie it back to your squiggles on the screen earlier, which is, as you have here with these, curves, market's going to market, right? You can't direct what the market's going to do. What you can do is have the KISS model react to that and, try to catch 70% of the upsides, but only 50% of the downsides. And over time,
90, correction, 90.
90% of the upside?
50% of the
Sorry,
downside.
90% of the upside, only get 50% of the downside, and over time have that 40, percentile differential just accrete and let compounding, do its magic for you.
Correct. Correct. Yeah. Let me draw a quick sideline diagram of what that looks like in portfolio net asset value terms. This is net asset value. Your portfolio should look like this. This is a bear market. Bear market. Bear market. The bear market should be flat performance in your portfolio. You should be trying to make money in a bear market as a retail investor. Here's what other people's portfolios look like.
Right.
You don't want all this. This is stressful as hell. This is how people get heart attacks, get divorced, get into big fights with their kids and stop speaking to their kids for years. This is how people lose their homes, their lifestyle. You don't want this. This is bad. Stop hodling. Start managing risk, especially if you're near or in retirement. It's so important to chop off the left tail of the distribution, but it's equally, if not more important, to get back fully invested as quickly as possible once you notice we're in a risk-on market regime. And that's exactly what KISS does for our retail clients, and that's what Dr. Mo does for our institutional clients.
All right. Well, Darius, look, I could go for hours with you, my friend. You're one of my very most favorite people to interview. And one of the reasons I love the interviews too is even if we only do an hour, you pack about 3 hours worth into it with all your data and just how eloquent you are. So for folks that are saying, okay, I want to learn more about this, I might even want to become a client of Darius's, where should they go to get connected with the KISS model?
Yeah, I appreciate you, Adam. And thank you. Again, I'll be honest, I don't come on these programs to gain.
I know you don't.
We don't need any more clients, man. We're doing fine. But the reality is I see a lot of investors out there not doing fine. And it's our mission to make sure that every investor has the opportunity to do fine. And what we mean by fine is not what everyone thinks about fine, which is, God knows what people are doing these days. I don't really pay attention, but we want people's portfolios to look like the portfolios of the top funds on global Wall Street. And they deserve that. And they don't have to pay 3 and 30 or 5 and 50 to participate in that. They can come by this research as low cost as any institutional research is on global Wall Street. And I'm really proud of that. I'm proud to say that because I want everyone to participate. I don't want to price regular people out of the market. Regular people deserve these insights and risk management signals. Wall Street, if you're paying attention, stop selling retail your tired, dusty pie charts and target date allocation funds so that they can provide the liquidity to your vol targeting and dynamic position sizing strategies that you use to compound returns from higher net asset values. I'm trying to twist Wall Street's dirty big game upon its head with 42 macros. So if you guys appreciate what we're trying to do here and what we are doing for our clients, check out our testimonials page. I don't have to say anything about what we're doing for our clients. They'll tell you. Come check us out at 42macro.com. I appreciate you, Adam.
All right. Well, thank you, my friend. You might not appreciate me. And Darius, when I edit this, I'll put the link up on the screen. Folks, the link will be in the description below the video too. You might not appreciate me after asking this last question here, because I'm only going to give you like a minute or two of time to talk about it, where we could do a whole video on it. Sure. We did spend a lot of time on this in one of your past appearances on the channel, but let me just read this thing that you wrote recently, and I just want to give whatever exposition you'd like to give to this audience. Profligate spending by the Democrats, debt finance tax cuts by the GOP, and a bipartisan commitment to put profits over people via globalization and the unfair treatment of capital, income versus labor income in our society is how we got into this mess. Now we have a country full of angry tribalists, red versus blue, left versus right, arguing over the solution to our crippling inequality. Darius, how do we get out of this in the long run?
I'll tell you, our mutual friend Neil Howell thinks we get out of it.
A lot of pain.
It's not the way you want to get out of it.
Yeah.
You prefer, and you gave me a minute, so I'm going to use a minute.
I mean, just give us your concise. It doesn't have to be exactly 60 seconds.
Well, it's hard to concise this down because this is.
I know. So I said you're not going to appreciate me for pulling this on you.
Financial market and political history, but the historical pattern of getting out of this starting point, which is a increasingly K-shaped economy and society, really a K-shaped society, that people who have voting, who vote and or are willing to pick up pitchfork, musket, and gun to revolt, you have enough people on the bottom part of the K that are fed up and say, this system doesn't work for me. These institutions don't work for me. And I just named what I can observe in our empirical analysis. I don't think there's a human being on global Wall Street that does more empirical analysis and creates more charts than I do on a regular basis. Our macro scouting reports are 200 slides these days monthly because there's so much stuff going on. But based on our analysis, what we can observe in our analysis, the four big institutions that are the primary culprit of the K, and I guess you can layer on monetary policy as the fifth, but it's the profligate spending by the Democrats. 37% of only 17% of government spending goes to poor people. We can track it by line item. We looked at all 678 line items of the federal budget. So only 17%, 46% is going to the middle class. You could say the middle class via the Social Security, Medicare, but the other 37%, of which big checks, $billion checks, are going to guys like Elon Musk and Alex Karp and whoever runs Boeing and whoever runs all these other companies that sell stuff to the government. That 37% is going, a lot of it's going to the top part of the K. We don't need to be giving rich people money. We're giving rich people money with an unfair treatment of capital versus labor income. You got 1031 pass-throughs, 1098 business deductions. You got all kinds of deductions if you're rich, but if you're a laborer, there are no deductions. You just get taxed at whatever, marginal tax rate and effective tax rate you're going to be in. So that's another institution. You have these debt finance tax cuts that, again, based on the current tax set system that favors capital over labor, wage income, capital income versus wage income. Anytime Republicans cut taxes, it's obviously going to get, disproportionately benefit the folks at the top part of the K with all the capital. 90% of the financial assets are owned by 20% of the households in this country. So those things continue to compound this K-shaped dynamic. Obviously, you had a decade plus 15 years of, ridiculously easy monetary policy. Ben Bernanke adopted the lost decade in Japan and went full bore on that. Obviously, Yellen and Powell kind of ran with that as well. That was contributory as well. And then finally, this globalization pig. We shipped all of our jobs to China, Mexico. Now it's going to be Vietnam and India. And the reality is we've hollowed out our domestic manufacturing base. And as a function of that, we've hollowed out our middle class. And so all these, pillars, these institutions, all of which, by the way, made Wall Street very rich in the process and created booming markets in the process, really left behind a very large share of our society, an increasingly large share of our society. And this is why we've been fraught with so much political volatility in the last, let's call it 15 years. And so historically speaking, and I'll shut up, this usually ends in total war. I would love for it not to end in total war. This is partially why I hop on programs like this and preach so much beyond our paywall and use my Twitter account, not just as a tool to educate the masses, but also as a platform to push this, data-driven centrist style of thinking into the world so that perhaps maybe we can avoid the total war and the big collapse and the big climax of the fourth turning that has historically been so painful for society. I don't want that. I'm a new dad. I don't want that at all. But I'm trying to use the skills and the intellect that God gave me to not only create good outcomes in our client portfolios, but just as important, if not more important for me personally, create good outcomes in society.
All right. Well, first off, let me tell you how grateful I am that you are using your skills for that. Your Twitter handle where folks can follow you on, or X handle, that's at 42 Macro, correct?
Yeah, 42 Macro is our company Twitter. 42 Macro, D Dale, DDALE is my personal Twitter handle.
Okay. I'll put both up on the screen for folks. Darius, I do want to, I'd love to get you, on the platform here at some point in time to delve more deeply into some of these really big risks that we face, sort of societal risks that we face. We'll put the slides to the side.
Let's do that. Let's do like a 15 to 20 minute unpacking of each one of those things, and we can use it as evergreen content.
I would love that. I think the audience would love it. I do want to nod that we are trying to also create a conversation with Luke Roman, who this audience knows well as well. And I think that discussion will be fantastic. Folks, TBD on when the timing that is going to be, but hopefully that's something we can line up in the next couple of weeks, maybe a month or so. Absolutely.
Adam, man. I just want to say thank you again. I know every time we get together, we're man hugging each other over the airwaves, but you're one of my favorite people, man. I can tell that, you share my mission, both to democratize the very best of Wall Street, but also to make the world a better place and use whatever skills God gave us to make the world a better place. And I appreciate you for being on that journey with me, brother.
Well, thank you, my friend. That's very kind of you. And I can't wait to give you a big man hug in person. You're going to be out on my side of the country in the not too distant future. And it's going to be fun to finally get to meet you in person, my friend.
Likewise. I'll see if you have legs and feet.
I think I do. All right, and same with you. All right, well, look, folks, please, if you enjoyed this even just a scintilla as much as I did, and I'm sure you probably enjoyed it even more than me, please let Darius know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And folks, for those DIY folks of you that would like to take advantage of the KISS model, obviously go over to 42macro.com and look into that. If you are not a DIY, but you would like help in navigating this future that Darius sees ahead of us, and it seems like he sees a fair amount of opportunity there, I highly recommend most people watching this get that help from a good professional financial advisor. Importantly, one that takes into account all the macro issues that Darius has talked about here. If you've got a good one who's doing that for you, great. You should stick with them. But if you don't, or you just like a second opinion from one that does meet that criteria, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To set up one of those consultations, just fill out the short form at thoughtfulmoney.com. Only takes a couple seconds to fill out the form. These consultations are totally free. There's no commitments to working with these firms. It's just a service they offer to be as helpful as possible. Darius, it's always just such a joy and a pleasure. Look forward to seeing you soon.
Appreciate you, brother. I'll see you next week.
All righty. Everybody else, thanks so much for watching.